In a world of low rates and tight credit spreads, we're constantly looking for innovative ways to deliver higher after-tax yields to our investors.
Liquidity has been a source of investor frustration in recent years. Since the financial crisis, available liquidity in the muni market, so these are market makers that provide bids and offers every day, that liquidity has declined. Over the same time period, funds with daily liquidity offered to investors, like open-ended mutual funds, have increased in size. So there's a growing mismatch between the available liquidity and investors that might demand that liquidity. As a result, during outflow cycles in the muni market, what we've experienced are overshoots, where valuations, prices really overshoot fundamentals.
During the past decade, every 3 to 4 years, we've seen large outflow cycles.
Back in 2010 and 11, following Meredith Whitney's proclamation on 60 Minutes that there would be billions of municipal defaults, caused an outflow cycle. In 2013, after the Fed-induced taper tantrum, that coincided in the muni market with a downgrade of Puerto Rico and also Detroit filing for bankruptcy. So we saw a prolonged outflow cycle.
Most recently in 2016, following the presidential election, fears of lower taxes and higher interest rates led to an outflow cycle and a resultant spike in yields. In these sell-offs, most muni funds have to raise cash to meet redemptions. We don't see outflow cycles going away. In fact, we think they're probably going to become more common and potentially more severe.
We do see an opportunity here, but it really needs to be an investment vehicle that's not subject to the same daily liquidity demands.
We think a product that has less liquidity, like an interval fund, can be particularly compelling for long-term investors because it can stay invested and actually deploy capital during market sell-offs as yields rise.
That puts us as portfolio managers in a better position to take advantage of these outflow cycles, make opportunistic purchases, and create long-term value for investors that expect to be allocated to the muni market for a prolonged period of time.